Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. My guest today is Professor Steve Hanke. Always a pleasure having Steve on the show. And today we dive into the changes or not changes that will occur with this new American administration. I really wanted to get his thoughts on what's hyperbole, what's real, where he thinks changes will actually occur, and what will probably maintain as status quo. He had amazing perspective and context, and I really appreciated having Stephen on this week. I know you're going to love this interview. And right before we jump in, a quick reminder, I'm hosting my annual conference, the Vancouver Resource Investment Conference, in January 19th and 20th at the Vancouver Convention Center. A rockstar lineup of over 120 keynote speakers and 350 investment opportunities in the mining business. It's an absolute blockbuster of an event. Check out cambridgehouse.com for tickets. But more importantly, here is Professor Steve Hanke. Enjoy.
This is Jay Martin.
All right, here I am with Professor Steve Hanke. It's great to have you back in the program. Thanks for making the time.
Great to be with you, Jay.
Let's start here. There's a handful of directions that I want to go today, but we just wrapped up a fairly consequential election. We've seen a rally come out of this election immediately. Do you think this signifies any kind of a paradigm shift at all, or is this near-term reactionary activity?
I think it's near-term reactionary activity. We don't really know with clarity even what's coming down the pike. So that was an initial reaction. My take, by the way, I predicted that Trump would sweep the election, and which he did, and the basis for that was the fact that I look at markets and market prices, and we had prediction markets, several, 7 or 8 of them, and those prediction markets all indicated that Trump was not only leading but surging right across the board. Whether you looked at the contentious states that were kind of in dispute, the 7 states, or looked at the overall picture, the betting markets were telling you Trump was going to run away with it. But the polls kept saying, no, it's going to be a toss-up. And the polls were kind of consistent with what you were reading in the press. The press spin, of course, was all anti-Trump. And what that is, it's all subjective. The polling data are subjective, and of course what you read in the newspaper, as I've indicated to you before, Jay, Hanke's 95% rule. 95% of what you read in the mainstream press is either wrong or irrelevant. And it was true in spades in this election. So what was objective? What's objective is what's in the betting markets, the prediction markets, because people have their own skin in the game, and they're incentivized to place prudent bets and wagers, which they do, and that kind of sucks in everybody's subjective view about what's going to happen. Every bettor has a subjective view and preference and so forth for what they think is going to happen. And the market collects all that betting into one objective price and probability of winning. It's the same thing like the stock market. You know very well, every analyst, every cat and dog out there analyzing something has a different subjective view about what the value of a stock is. But all of those views come together with buyers and sellers in what? The stock market, and you have an objective price. You can't. The price is the price. You can't argue about it. That's what the market objectively thinks the stock is worth at any particular point in time. So that's the logic of the thing. Now, my own take, kind of analytically, of why this happened is that I think it was a revolt of the general population against the elites in the media, the elites in Washington, the elites, you name it, at universities, et cetera, et cetera. It also gets into the income distribution picture. And we'll talk about this maybe a little bit more later in our discussion today. But if you look at what happened when COVID started, if you take the size of billionaires' wealth in March of 2020 and take that as a percent of GDP, you get 14.2%. Then the next data point that I have is the billionaires' total stock of wealth in September of this year as a percent of nominal GDP in September of this year, and the number is 21.2%. You had a massive increase in wealth of the wealthiest people in the country, the elites, so to speak. And this is something people just haven't gotten onto. This is an income distribution issue, income inequality. What happened with Bidenomics and the Biden administration? They're left-wing progressive government, the most left-wing government we've had in the United States, certainly since World War II. There's no question about that. And their rhetoric was, oh, they're going to watch out for the little guy, the little guy. We're taking care of the middle class, the little guy. What happened, like most of these limousine liberals on the left, they took care of the rich, their own class, the elites, and the little guy, forget it. If you look down at the bottom of the pyramid, the little guy's income didn't even keep up with inflation. Their real income adjusted for inflation actually went down. So of course, they're a little bit annoyed. They know they missed the gravy train basically, and that goes all the way up into the middle class. So you had a huge block of voters that I would say we've entered a new realm, the realm of the age of resentment. This is all about resentment. That's my analytics on what actually happened and why the betting markets were showing that Trump was going to win big time. So that's kind of the election. Now the question is, well, how did this happen? How did the rich become so much richer? I mean, I looked at the numbers, Jay, when I was calculating this thing. I had 3 assistants working on the thing. I blind tested the thing. I didn't believe the numbers.
Really?
They're so fantastic. I mean, if you go from billionaires having wealth equal to 14.2% of GDP, going up to 21.2, it kind of is a shocker. Now, the reason for that is pretty simple, actually. If you look at the way I look at the economy, you have to have a model for national income determination. Now, what's that mean, national income determination? That means where is nominal GDP going? And nominal GDP contains 2 components, the real growth rate in the economy and the rate of inflation. If you add both those things together, you get nominal GDP. And the model to allow you to do that accurately is what is called the quantity theory of money, which has been around since the 16th century, which I embrace. So money, basically, if you have changes in the money supply, you're going to get changes eventually in nominal GDP. And that means real economic activity and inflation. So here's the way it goes. The transmission mechanism is as follows. You have a big change in the money supply, and then the next thing that happens with a lag of 1 to 9 months is asset prices change. And then with a lag of about 6 to 18 months, real economic activity changes, and then with a lag of about 12 to 24 months, inflation changes. So what did you have when we had this starting with March of 2020? Remember, that's the date I gave you for the billionaires, the first data point for the billionaires, March of 2020. They had 14.2% of GDP. Okay, now you goose the money supply, and by February of 2021, the money supply was growing at a rate of a little over 17% year over year. That's the highest rate of growth we've ever had in the money supply since the Fed was founded in 1913. And what happened? Of course, the transmission mechanism. Remember, the next thing that happens is asset prices go up. So if you look at the change in asset prices from March 2020 to December of 2021, the S&P went up 114%. Iowa farmland, the state I'm from, went up 30.4%. Residential real estate went up 44.3%. Now, who owns those assets? Well, rich people do. The billionaires do. So that's why you have this huge skew in the thing. So you have the mix of it was, of course, the Biden administration expanded the fiscal deficit tremendously, and then the Fed comes into the picture. So first, fiscal expansion, huge deficit. The Treasury has to sell more bonds. Who bought 90% of the bonds that were being issued to finance that deficit? The Fed did. And when the Fed does that, of course, it buys them on credit that it creates out of thin air, and the money supply goes up. That's why the money supply went shooting up. So it's an interaction between the reckless fiscal policy of the Biden administration coupled with and facilitated by the Fed buying those treasuries and increasing the money supply. So that's the nub of the election and thinking about it. So you had two actors that were very critical to increasing billionaires' wealth and skewing, making a mess out of the income distribution in the United States, the Biden administration's fiscal activity, and the Federal Reserve. So the idea that the Federal Reserve and big changes in the money supply, it's just nonsense. They're not neutral. Different groups and factions in the economy are disproportionately affected by changes in the money supply.
Yeah, 100%. Thank you for that. That was incredibly comprehensive. And I feel that even if people don't quite understand or didn't have an understanding of why, they understood how they felt, right? Maybe they didn't know the money supply was growing at 17%. They weren't watching residential real estate increase by 43%, the S&P up by, what did you say, 114%.
Yes.
They weren't following fiscal policy. They weren't following monetary policy, but they did understand how their life was getting harder. And that's enough, right? You experience the symptom. You don't even have to understand the cause. Sometimes that's a problem, but I think that wraps up the sentiment that you're discussing here. Now, I have a question for you based off of something you said.
Yeah, Jay, this is the resentment thing. You see,
Yes.
they don't have to follow all these numbers and have a model or anything like that. They kind of know in their gut that a lot of people are really getting rich and they're falling behind.
And they're falling behind.
And that's one thing they know. The other thing they know is that people in Washington, D.C., and the media, which is echoing what's going on in Washington, D.C., are telling them what to do. And people don't like that, especially part of this period. Remember, they told us that you were locked down. You couldn't even go to work. Remember COVID?
Yes, I do. And you're right. Don't like being told what to do. Don't like being told what to think. And I think people are also beginning to understand what that means. And, to summarize, that means they're beginning to understand that Washington is donor occupied territory. And maybe the messages that are coming out of Washington are built to cater to a select few. Those same select few who went from 14% up to 22% wealth as a percent of GDP.
Absolutely, and people have some idea. You have the lobbyist in Washington. The biggest growth industry in the United States was lobbyists. Now, why?
Wow.
Because Biden was running a big gravy train. Bidenomics was a huge income redistribution operation, in which the fat cats got fatter, and they got fatter in part about what the Fed was doing. That part I've explained, but also they were directly getting handouts via their lobbyists. Why do you think they're paying millions of dollars a year for lobbyists in Washington? They think it's going to pay off,
Yeah,
and it does, or it
right.
did with the Biden administration.
It did. Yeah. I have a question about something you mentioned right at the beginning. So first of all, the polls were calling for a toss up, really saying this thing's split, down to the hair. The poly market, the opposite. The poly market was calling for the betting market, calling for a landslide victory that actually ended up occurring. And as I was watching that materialize, I thought, these polling companies rely on their credibility, and their credibility comes from accuracy. And they've been really wrong many times over the last 8-10 years. The red wave never occurred. Nobody predicted a Trump presidency to begin with, et cetera. And so the only safe call they could make was the coin toss. Then they were kind of safe no matter what happened. And I wondered, like, that's an archaic industry that's becoming less and less relevant. And this election really showed that these are professional polling companies that are dependent on their accurate results to be relevant in the future. And if they have had that confidence shaken, they're just going to sit on the fence and play it safe.
Right. So there was a lot of herding that went on the last month or so, and all the polls came together. If you look, the dispersion of the polling became less and less, and they were trying to cover their backsides by saying, "Well, we all got it wrong." I mean, don't point your finger at me. Everybody else was saying the same thing. The
Yeah.
problem is what you just enunciated, and that is the average guy realizes that these polls are rubbish and subjective. They're not objective. And they'll start looking at things like poly markets and other betting venues in the future. That's one aspect of the thing. The other aspect is the media, because the media was telling us what? Essentially the same thing that the polls were telling. And if you looked at the news, what they call news was most of the news, even in places like the New York Times or the big media, they were almost, you'd read a news item, it was like an opinion piece. It was like an op-ed. It wasn't news. Or you listen to the television's even worse. So what I think is going to happen is there are going to be more and more of alternative media sources. Podcasting, by the way, your business was huge. People were turning away from mainline news and listening to podcasts because they thought they were getting better information.
Do you want to hear a crazy stat? So YouTube has become the world's biggest podcast platform. It streams more podcasts than Spotify, Apple iTunes, et cetera. During this election, Trump generated 142 million views on YouTube podcast appearances. Harris generated 4 million. 142 million to 4. Now, that's largely a consequence of where they focused their attention, right? Trump went hard at podcasts, and people say, oh, they're all friendly and partisan. Like, doesn't matter. That's where he applied his energy and his campaign's energy. And those numbers speak for themselves. And really, again, talking about, maybe polling companies becoming archaic and less relevant. Media has been going that way. Like we know that. But when you think about that disparity in distribution numbers for podcast episodes, and then you look at their campaign budgets, I think Harris had 950 million direct campaign budget and went 300 million over that. Whereas Trump's was like 390, and I believe he underspent, but one chased bought media, one chased earned media. But they say like you can track the shifts in media cycles by watching the election cycles, and you can go back to like, was it Nixon and JFK that was the first televised presidential debate? And a lot of people credit JFK looking sort of young and energetic, and Nixon looking tired and sweaty to why he lost that election. And you can carry that forward and look at various election cycles and say it's a reflection of how the media is evolving.
Absolutely. Now, just repeat those podcast numbers for me. Trump had 140 million views, and Harris had 4 million. Is that right?
Correct. 142 collectively for the Trump campaign.
142.
Yeah.
Now that you put your finger on, that's a very interesting statistic. I wasn't aware of that, but it comes in to the whole elite thing and how the elite try to manipulate things. Now Joe Rogan had this huge uh, program, where he had Trump on, and I don't know how many million views, 35 million or something like that.
Hmm.
You probably know the exact number, but it was very large. Now Harris took and Trump just went on and did what Trump does, just talking. And what did Harris do? She said she was invited, and she said she would go on Joe Rogan, but only if she could control the thing. And this is just a no go. This is what the elite establishment wants to control everything, including your life, and that's why you kind of have this thing going on, the age of resentment. People don't like that.
Yeah. Agreed. Agreed.
So
Agreed.
so at any rate, this I think we've, to my satisfaction, kind of covered the kind of election, and how I viewed the thing, and the shocker to me, there are two shockers. You gave one shocker, and that's the podcast influence. And by the way, that creates what's called the image. One of my professors, Kenneth Boulding, very famous economist, by the way, he wrote a book called The Image, and it's all about the image. I mean, that's how people process information. They get an image, and once they have the image, it's very hard to change it. By the way, for data coming in,
Right.
because
Right.
data run through the image. So that's one aspect of it. I think my main contribution is this billionaires thing, which I think is stunning, and tells the whole story of Bidenomics. Bidenomics was for the rich, totally for the rich, and too many little guys felt left out, and decided they'd vote the so-called incumbents out.
Yeah. Now, following that thread, you said earlier we don't know clearly what's coming down the pipe yet from this administration. There's been a rally. That's probably reactionary activity. Um, do you see a shift in paradigm at the establishment level then? Because Washington is still Washington. Those lobby groups are still there. We have a new individual in the president's seat, but the pressures exist still. Will he be able to withstand those? Or will Bidenomics put a new sign on the door and continue with business as usual?
Well, if the first term he wasn't successful in draining the swamp. The elites controlled the thing. Now, this is all very problematic. Of course, Elon Musk is going to be his right hand man in cleaning the swamp, and and we'll have to wait to see if he's able to do it. But the swamp is a lot bigger than it was in the first term of Trump, because
Mm-hmm.
remember, all these quarterly employment reports that we've been getting ever since COVID, the biggest increase in employment is always what? Government employees. So there's been a huge increase in the number of civil servants in the United States since COVID, and the question is whether they're going to whittle that down or not. Traditionally, this is pretty hard to do. So
Right.
stay tuned.
Yeah.
Stay tuned.
Okay. Yeah. Agreed. Agreed. You've got an individual in there who has a track record of eliminating surplus expenditures, most recently at X. Can he apply the same strategy within a government and get the same results and chop the? That's where you go, I guess.
Yeah, the history of this kind of thing, by the way, is really leaves me to become skeptical of the possibilities. And
Mm,
if you go back to when I was one of President Reagan's advisors in the early 1980s, Reagan had the same idea, government efficiency. We were going to have a government efficiency commission, and Peter Grace of W.R. Grace was the chairman of that commission, and I contributed to it. He had, I don't know how many volumes of studies that they did on how to cut waste, fraud, and abuse, but nothing ever happened except the publication of the commission's multi-volume
Oh,
report.
interesting.
So it's a tough nut to crack.
Yeah. Yeah. Well, no doubt. No doubt. The roots are deep. And I feel that the majority of individuals, such as yourself, who have sort of like insider relationships into how this organization works, because you've advised President Reagan, like you've been in the room, are far more pessimistic that the new president will be able to change nearly as much as he hopes. That seems to be the overwhelming consensus that I hear.
So I think it's one of those things that it should be good for you because, as I say, stay tuned.
Yeah, right. I'll take it. I'll take it.
We'll take a look at this thing in a few months and see how it's going. I mean,
Yeah,
certainly Musk, Peter Grace was a very distinguished and successful businessman, but he and Elon Musk are, I think, a little bit different breed of cat, shall we say?
sure,
So
sure,
we don't know.
sure. Okay, so
By the way, cleaning up a government mess is a completely different game than cleaning up a private corporation. By the way,
yeah, that makes sense. Can you give me a couple examples as to why?
well, number one, the civil servants are not you know they have a certain set of rights and so forth that are different than a private employee. I mean, for most private employees, the owner of the company can give them a pink slip. Well, it's not quite that easy in the government. And getting rid of departments, for example, in the government is not quite that easy because, number one,
Hmm.
not only you have the legal entitlements that the civil servants have, but also you've got Congress. And if you think civil servants are just floating out there in outer space, they have their lobbyists too. And they have their friends on Capitol Hill. Just think of this. We've been going at this, and I did some of the original work on this, base closures for the Department of Defense. We have many Army bases, naval bases, Air Force bases, and so forth that aren't really used and are redundant and so forth, scattered around in all 50 states. So if you want to close the ones that are redundant, it makes a lot of sense. You privatize them, but this is very difficult to do because if you have a base down in Texas that's redundant and you want to close it, well, you have two senators from Texas and you have a number of congressmen from Texas, and they're going to probably dig in their heels and they won't want you to privatize that thing and close it down.
Yeah,
So that's the institutional setup and the legal setup is completely different than government, and the incentives are completely different than in the private sector.
mm.
And this gets into, by the way, if in the private sector, businesses operate in what? A profit and loss system. So if bad decisions are made, what happens? Well, you make losses, number one, and if you make too many losses, you go bankrupt and go out of business. That's the incentive structure. The incentive structure in Washington, D.C., people who make the decisions are not responsible for them in the sense that the axe comes down on them if they make a bad decision. What happens if they make a bad decision? It gets swept under the rug and people forget about it.
Mm.
There's no ex post accounting for how things are going. They pass a piece of legislation. They appropriate billions of dollars for it, and and it's like these EV charging stations in the United States. We remember the Inflation Reduction Act that allocated billions of dollars to invest in EV charging stations all over the United States. Well, they've hardly been able to construct one of the things. It's just a handful of the things that have been constructed.
Hmm.
But no one's going
Yeah.
to look back after the fact and say this thing didn't work.
No.
Who's responsible? Let's axe them.
Hmm.
It never happens.
Hmm. Agreed. Now, expanding our point of view to the global stage, does this president, I mean, he projects differently. He conducts international relationships very differently. That's for certain. But inside of 4 years, can you make much of a change to the United States position as it stands right now? And you look
Oh
at,
yeah, yes, potentially. Look at the dramatic change that Biden made,
right. Okay.
and
Good
and
point.
look at the numbers that I get. Yeah, it makes a difference who's
Good
in
point.
who's in the White House and who's in Congress.
Hmm. Okay. So then could I get you to extrapolate on that a little bit, and it sounds to me like that will be a very positive change. This will be a positive change. The last 4 years was a surge in international conflicts, U.S. meddling in those conflicts, and global uncertainty to a very large degree, to summarize. So could we see the opposite of that, or a retractment in some way?
I well, we've got two hot wars going, and one kind of simmering. Two hot wars: Ukraine and obviously the Middle East with Israel's military operations, and the one that's kind of simmering in the background is China.
Mm-hmm.
So let's just conjecture about what Trump. I think the war is over in Ukraine. The Russians have cleaned the clock of the Ukrainians, which of course everybody knew was going to happen, and I think the Russians will drive an extremely hard bargain, and they're very clear about what the bargain will be. They keep all the territory that they're now occupying in eastern Ukraine. They'll keep Crimea. Ukraine will not enter NATO and be a neutral state. That's the outlines of the basics of what's going to happen. And I think Trump will want to facilitate that because he said he's going to shut that war down in 24 hours. So that's Ukraine. The
Mm.
Middle East, I think he will be even more pro Israel and in bed with with Netanyahu than Biden was. So
Mm.
so I'm very pessimistic about what's going on in the Middle East because I think Netanyahu not only ran circles around Biden, he'll run circles around Trump too. So that's that conflict. Now China is a big question mark, and remember that Trump had kind of started this antagonistic behavior with China. Biden did more so, and now you've got Trump coming back and threatening all kinds of, I think, stupid policies with increasing tariffs and protectionism, and the question there, Elon Musk comes into the picture because Musk has a lot of interest in China, and there are other people around Trump who are not neoconservatives who have business interest in China, and they might change the picture with the United States vis-a-vis China. But I think it's too early to tell because we don't know what the configuration of personalities is actually going to be around Trump. But one who will be influential clearly is Elon Musk, and Elon Musk doesn't. I'm positive doesn't has no interest in going to war with China. He has an interest in doing business with China.
Yeah. Okay. So to summarize, to a certain degree, um, Trump has made his announce or his promise. He's going to end the war in Ukraine, Russia in 24 hours. I think you take a statement like that, take it seriously, not literally. It'll be on his desk on day one. May take a bit longer, but that's going to be a huge priority, is ending that quickly.
Yeah, yeah, that one's a no-brainer because it's ended. Russia's won. The press just hasn't told us this in the West. It's over.
That's a really
It's
good
over.
point. No, what you just said, because the first 20 minutes of this conversation, we're discussing the misleading narratives coming out of the mainstream press in regards to this relation. We're getting the same narratives about so many other issues, this being one. And it's important to remember how incorrect and manipulative those headlines were about the election, and apply that filter to everything you hear, including the war on Ukraine, Russia. Like you just said, it's over. We just haven't been told yet. That's interesting.
And the Middle East is another can of worms. And as I say, I think Netanyahu's in complete control of the reality of what's going to happen on the ground.
Interesting. Okay.
And we talked about lobbyists. Remember the Israeli lobby. There is no lobby in the United States that even comes close to being as powerful as the Israeli lobby. And all you have to do is read John Mersheimer's book on the Israeli lobby, which he wrote. Now it's been 7 years ago. That's a definitive book on how this operates. And that's how it's been operating, by the way, throughout the post October 7th conflict in the Middle East.
Okay. And then the third simmering conflict being China. Yeah. Yeah.
China remains, I would say, kind of up in the air. I am totally against protectionism in all of its forms. That's whether there's sanctions. I'm against all sanctions. I'm against all tariffs, and I'm against all quotas. So
Okay.
see, most people view trade, by the way, incorrectly. This is kind of a technical point, but it's simple. And let's think about it. If you have a foreigner selling something to me in the United States, and we agree as to the terms of the sale and the price and everything, it's a positive sum game. The seller, the foreign seller, thinks they're going to get benefit from it, or otherwise they wouldn't sell it to me. And I think I'm going to benefit from buying it, otherwise I'd never buy it. So it's a positive sum game. Most people think about trade as a negative, not a negative sum, a zero sum game. That somebody gains on one side, and that's offset by a loss that's equal to the gain on the other side. It's not the way it works. It's a wrong way to think about things. Trade is always a positive sum game. It's always good, not bad.
That's a really good point.
And it's not zero.
So I agree with you there in principle. And I think if there was anybody pushing back in the comments, they would say, yes, but when you run a trade deficit that's too steep for too long, you need to do something to correct it. And maybe these measures are an attempt at that, effective or not. And I agree with you. I don't think the tariffs and sanctions are effective at all. But what would you say to that pushback?
Okay, that pushback is by someone who doesn't understand the trade balance. Why there is a trade balance. Now, I wrote an article about this with Ed Lee in the Journal of Applied Corporate Finance a couple of years ago. The first one that actually has all the numbers in it. And there's an identity in the economy, and the identity that must hold is that savings equals investment. And if savings are less than investment, and you have a savings deficiency, you will have a trade deficit. And that's just again working out these identities. So we have had a savings deficiency in the United States since 1975. We've had a trade deficit every single year. It hasn't been the end of the year, the end of the line. we keep running these huge trade deficits. We can do that easily because the U.S. dollar is the international currency. We can easily borrow in U.S. dollar. Everyone wants to loan us money, and that's how we finance the deficiency. We make up for the deficiency, the savings low. And when I talk about savings versus investment, you have to aggregate the savings and investment in the public sector and the private sector to get the total. And so what we actually have a savings surplus in the private sector, but the deficiency comes from the public sector. We run public deficits. If you take state and local government as well as federal government, we run deficits. And it turns out that our trade deficit, just exactly what the identity tells us would happen, it's almost exactly what the federal deficit is each year. Mm. So we have a savings deficiency. That is mainly because of the federal fiscal deficit, and that must be equal to the trade deficit that we have, which it is. And you can read the article in our Journal of Applied Corporate Finance article on that to get it. So the pushback is the following. Well, there are countries where they have a savings surplus, huge savings surplus, like China. And that's why they have a huge trade surplus. It isn't this forget the overcapacity argument they're running around with. It's a fact that Chinese, there is no network, social network that's going to be taking care of their retirement. So they save a tremendous amount. They don't consume very much, by the way. They don't consume very much. They have income. They're not consuming very much, and that residual, they're saving, building up saving for retirement and so forth. So that's why they have a big surplus. Another country that always has a big trade surplus is Switzerland. Why? Because the Swiss are tight. They save way more than they invest, and they run a trade surplus. And a lot of people, by the way, it's interesting. A lot of people say, "Oh, the Chinese, they have a weak currency. That's why they're running this surplus. They're bombarding us with exports because the Chinese RMB is very weak relative to the dollar." That's nonsense. The Swiss franc is the strongest currency in the world since 1917, the end of the First World War. The real inflation-adjusted value of the Swiss franc has actually gone up. It's the only currency who's had a real appreciation over that period of time. It's actually the strongest currency in the world over a long period of time. And they run these huge trade surpluses with that strong currency. And it's because of the savings-investment relationship and the fact that they have a big surplus of savings.
So how
the Germans, by the way, have been more or less the same way. They have a lot of savings. They don't consume that much relative to their income. They save a lot, and they run big trade surpluses. So you go around the world, and if they're running a trade surplus, I can tell you, we know axiomatically that they are saving more than they're investing. Mm-hmm. If they're running trade deficits, we know they're saving much less than they're investing.
Mm-hmm. That's a better perspective, and one I haven't actually heard, I don't think, on this show. Stephen, talk to the, a lot of my audience, the majority of my audience are retail investors. They tune in because they're trying to understand geopolitics, macro, in order to make the smartest decisions with their capital, right? How should investors read the landscape right now? There's a lot of unknowns, a lot of uncertainties, and a lot of to be determines. Valuations are still crazy. Tough to find value, it seems. I struggle right now. There's a couple of things that I'm looking at, but what's catching your attention right now for the average investor?
Well, we have a lot of risk. We've talked about some of these things. The war risk, I don't think it's priced in. The risk that we're kind of in a an overvaluation zone in the market. Everything's very pricey. The fact that we still have this big push for this green transition, which is extremely costly, and we have a new administration coming in to the United States, and we that's a risk. We don't exactly know what they're going to do. It's not going to be a continuation of Biden. We know that for sure. Or the voters at least don't think it's going to be a continuation of Biden. That's why they voted against Harris. So we have a lot of risk in the picture. And I think people are probably overweighted in what we call risk assets, equities in general, or speculative assets. So that's one thing. And you see somebody like Warren Buffett is piling up cash. Apple, he's sold down a lot of Apple. It's still his biggest holding. But the fact is he's been a continuous seller, I think rebalancing his portfolio, but lightening up on the risk assets. That's Buffett, and that would be Hanke. So then what to do? Well, gold, I think, is still in the early phases of a bull market. Even though we had a big pullback today, it's a good buying opportunity for gold. That I don't view that as a risk asset. Also, I think the 10-year U.S. government bond is a good buy. It's pulled back a lot in the last 3 weeks or so, and I think a good buying opportunity. The yield's good, and the yield will go down because inflation is headed down. It's at 2.4% now. Sometime next year, I think it'll be below the Fed's inflation target of 2%. And the reason for that is that the money supply is actually less than it was in July of 2022. We've only had 4 contractions like that in the history of the Fed since it was established in 1913. Every one of those either ended in a recession or the Great Depression. And what does that mean? It means if inflation goes down, bond yields go down. Bond yields follow inflation. The sequence is the money supply goes down, inflation goes down, and bond yields follow all of that, and they go down. And when bond yields go down, the price of the bond goes up. So you're not only with a 10-year going to get a decent interest payout, but you're going to realize a capital gain on the bond that you're holding. So I would say lighten up a little bit on risk assets, given all these unknowns that we've talked about, and utilize those resources to go into U.S. government. That's a non-risk asset.
Mm-hmm.
I'm not saying that there's no risk in it. It can go against you, but it's not in the risk basket. And also gold.
I heard a stat this morning from Ed Dowd, and I need to check this out. I think he said Buffett, you referenced Warren Buffett, de-risking, going to cash, presently owns 3% of the U.S. Treasury market. Is that possible? Does that sound like a plausible?
I don't know the exact number. His holdings of treasuries are greater now, I think, than the Fed's.
It's not wild. Yeah, wild. Okay.
You can check that out too, because I don't have the numbers right in front of me, Jay, but he has a huge pile of cash.
Yeah.
And Buffett is not known as being somebody who is not astute when it comes to prognosis with regard to the market and where we're going.
No. I think anybody who's criticizing his strategy needs to take a look in the mirror and just ask themselves some questions. It's interesting to me, however, because on my show, often we have sort of libertarian-centric conversations. A lot of those focus on the fragility of the U.S. dollar, et cetera, et cetera, et cetera. But here's a guy who's built a career off being quite risk-averse, and he's parked an insane amount of his wealth in U.S. dollars. Now, you could make a couple theses off of that. You could say, at his age, he's just looking for the most boring static asset class available. And that's what he sees. You could also say there's just nothing else out there that he has any confidence in. And so it's a very consolidated bet. That's another way to look at this. It's gross exposure to US dollars. But obviously he's got very well thought out reasons. And, but what do you make of that? Because you said you run a very similar strategy right now, that you're doing the same thing.
Well, I mean the U.S. dollar. This old adage: buy dollars, wear diamonds. This nonsense. People talking about the U.S. dollar, unfortunately, has been made vulnerable with all the sanctions and weaponization of the dollar that have come. Every administration, by the way, since George W. Bush, Obama, Biden, Trump, they've all done it. But the dollar is king, and it's not going anyplace fast. And it's extremely strong right now, by the way. Extreme strength in the dollar. It's in the last few weeks made all-time highs against the dollar. The dollar index has. So the dollar is very strong, and it is king, and it's very hard to knock a king off the throne. If you look back the last 2,000 years, there's always been one international currency. There have only been 14 in the last 2,000 years. The dollar happens to be the king right now. It is the international currency. And you get people like in BRICS, the crypto crowd, all of these people are talking they're talking their own book, basically, when they're bad-mouthing the dollar.
Yeah, good point. Good point.
Why have BRICS? They were going to come up with a currency, an alternative, and so forth. It hasn't happened. It's very difficult. These changes don't happen very often. I think if you divide 14 into 2,000, you get like the average life of an international currency is about 300 years.
Okay. Yeah.
So on that basis, the dollar has a ways to go.
Yeah, that's very important context what you just provided, because it's fun to dump on the king, right? It's easy to get sucked into the doom and gloom narratives, and both of those things contribute to this conversation, which is the dollar's days are numbered, and all this stuff. It's really important to step back from that noise and you provided some better context. I appreciate that.
Of course, in that context, of course, Bitcoin, as you know, has made a new high. I mean, it pierced 80,000 as we speak. I don't know what it is right now. I don't have my iPhone with me, or I'd tell you what the price is. But at any rate, that is a highly speculative asset. That's always been my take on Bitcoin. And what did I say? You said, where should you be going with your portfolio? Well, I said lighten up on risk assets. Well, I'd say Bitcoin's probably one of the most risky possible assets you could be in. If you have Bitcoin in your portfolio, the risk factor goes up by multiples.
Okay. So pivoting a little bit.
By the way, I'm not saying I'm not investing in it. Never have, because I don't want to take on that kind of risk. But but the fact is, if people should be free to make that kind of speculative bet, but they should be aware of the risk involved. That's all.
Yeah, that all you're saying is, exactly. Be aware of the risk, because you go down that rabbit hole. And there's all sorts of noise and shameless promotion and high conviction forecasts that have no basis in reality. Not to say don't own it, just maybe think for yourself and understand the risks involved. Okay, I want to pivot slightly to do you have any thoughts on the rate cycle? We saw a 50 basis point cut. What's your expectation, Stephen, for 2025? We've got a month and a half left of the year here. Any thoughts?
If you look at the markets, you have to look at the Fed funds futures market, Chicago Mercantile Exchange, and it looks like another 25 basis point cut will be in the next Fed meeting. That's what the Fed funds futures market's telling us. So the key thing, though, monetary policy is not about interest rates. It's about changes in the money supply, and the money supply is growing at a very slow rate now. I mean, I said it's contracted, but if you look year over year, we're down at 2 point. Give the exact number. Yeah, 2.6. And to hit Hanke's golden growth rate, that's consistent with hitting the Fed's 2% inflation target, the money supply should be growing at about 6%. So it's growing way too slowly. So how do you get that up? Well, they should, instead of fooling around with the Fed funds rate and these 25 basis point reductions, they should stop quantitative tightening. They're shrinking the balance sheet of the Fed, and when they do that, it contracts the money supply, or it slows the rate of growth in the money supply. So that would be the big policy thing. Stop obsessing about the federal funds rate,
Okay.
and look at the Fed's balance sheet and stop the quantitative tightening. So that you get the rate of growth in the money supply back up to Hanke's golden growth rate of about 6%. That's consistent with hitting a 2% inflation target.
Now, is this quantitative tightening necessary in the short term to get inflation under control, and then we can expand a little bit? What's your take on that?
No. We've already gotten inflation. Forget the inflation story. It's already baked in the cake. It's going down because you've got these long lags of a year, 2 years between changes in the money supply and inflation. And if you look back a year ago or 2 years ago, the money supply was collapsing. They already have the thing in reverse, so it's just feeding through the system now.
I want to. You just published a new book, another book. So congratulations! What a massive undertaking these projects are. It's called Capital, Interest, and Waiting. And for anybody who's interested, I'm going to put a link right beneath this video that'll take you to a landing page. You can read all about it and place an order. I encourage you to. But Professor, would you mind walking us through why you wrote Capital, Interest, and Waiting and what readers can expect?
Well, there are two reasons for that. My co-author is Leland Yeager. Now, Yeager would have been 100 years of age this year. He's a very famous and distinguished economist. When he was 93, he met the Grim Reaper, and prior to that, we'd been working on this. I'd been, shall we say, his sounding board for 25 years. And as the day of reckoning approached, Leland called me and he said, I just don't think I can work on this manuscript anymore. And he'd asked me repeatedly, he says, if something ever happens to me, would you finish the book? And I kept saying, yeah, don't worry about it. Nothing's going to happen. But finally, about 10 days before he died, he sent me an email and said, the time had come, and would I finish the book? And I said, yes, I'll finish the book. So in his last will and testament, Leland entered yours truly with my promise. So I took the work that Leland had done, and some of it I'd worked on with him, and took the next 6 years to finish it. So that's why I finished it. But it is, I think, if I may pat myself on the back, a major contribution in capital theory and capital and interest theory. So if anybody's interested in monetary economics, interest rates, money markets, all of that, it's really all in there. And we start from kind of the beginning and go through all the puzzles and every controversies and everything, and sort all of them out. The kind of main contribution big contribution. The reason weighting is in the title is that, remember when you took principles of economics, the production function was always land, labor, and capital. You put land, labor, and capital in the production function, you get output. Well, we have land, labor, capital, and weighting. If you don't have weighting in the production function, you're not going to get much. Now, what's weighting? Weighting is not consuming today and waiting for some future time to collect and have income and in the future, and then consume or invest with it. And what's the price of waiting? The interest rate. You have to get paid in interest to wait. Otherwise, you'd consume everything today. If you didn't get paid in interest or a rate of return, why in the world would you want to be saving and investing in something and waiting for a future flow of income or capital gain to occur? So it's it changes the framework, the basic framework to think about economics.
I appreciate it, and it sounds very timely. I know we discussed it a little bit the last time you came on the show, but that concept of waiting, deferred gratification, lost these days.
And by the way, one just at 30,000 feet, societies that wait a lot grow fast. So if you don't have waiting, you're not going to have prosperity. If you have more waiting, you're going to have more prosperity.
Well, let's be patient then. Look, I appreciate it. And
as long as we're getting paid a good interest rate,
yeah,
why not wait?
Get in position and trust the process. 100%. 100%. For anybody who's interested, once again, I'm going to put a link like right beneath this. So just hit that link. It'll take you to a landing page where you can read all about the book, place an order. I encourage you to do that. Professor, I appreciate you coming back on the show today. I always enjoy catching up with you and always learn a lot. You provide amazing perspective and context to all the topics that we discuss here on a regular basis. So thank you very much.
Well, thank you for inviting me, Jay. Great to be with you.
All right.